We're in a market right now where it isn't enough for the economy to be strong. It has to be stronger than expected. And that's really the setup as we move through earnings season here. Because when you look at the data, foundation still looks solid. Consumer spending has held up, and the labor market, while cooling, is still stable. Jobless claims remain low, which tells us companies aren't broadly cutting jobs. But here's the shift. Markets are no longer rewarding good. They're rewarding better or worse than expected. That's especially important for earnings. From here, it's not just about growth, it's about margins and whether companies follow through on the investment story, particularly around AI. At the same time, the Fed remains in a holding pattern, waiting for clear evidence that inflation, especially tied to energy, continues to ease. And with a leadership transition ahead, markets are starting to focus more on how policy evolves, not just where it goes. Now, one area we're watching closely is labor market beneath the surface. Hiring has slowed, but firing hasn't picked up. That's the low fire, slow hire environment we've been describing. And one dynamic that may be helping, small business formation has remained relatively strong. So while you're hearing about layoffs in certain sectors, some of that labor may be getting absorbed into new business creation, which isn't always fully captured in real-time data. So when you step back, this isn't a story of deterioration, it's normalization. Growth is moderating, policy is steady, the labor market is cooling, not cracking. But expectations remain elevated, and that's where volatility can come from. The takeaway, stay focused on the fundamentals, not the headlines. Because in this environment, discipline matters more than ever. Thanks for tuning in. We'll see you next week with more insights.